Samit Vartak of SageOne's has written. Now, what Samit Vartak has done in that investor memo, he's analyzed the key characteristics of companies which were the best performers in the 8-year period from FY11 to FY19, March 2019. The study throws up some very interesting results, and let's try and take a peek into some of these findings. So, just very quickly, just so that people don't get confused, I'll run you the shortlisting criteria that Samit has used. The returns of at least 26% CAGR since FY11, and only the 800 largest companies as of FY11 end. He wanted to ensure that the liquidity on these companies is not an issue. The outcome that came in was pretty interesting. There were about 68 companies that have delivered over 26% returns from FY11 to FY19. Only 2 were in the top 100 list as of FY11. 15 companies were in the 101 to 250 list as of FY11, and 51 of the companies which are the best performing companies delivering 26% returns were amongst the list of 251 to 800 in terms of their size. And remember, all of this is as per FY11. Now, the interesting bit is, you would have thought that in this period consumer companies have done well, and therefore a large proportion would be consumer companies. Summit's findings seem to suggest that that was not the case, because only 12 of the 68 companies were consumer facing. The remaining all, and Summit's words, were commodity facing companies which did not have pricing power or which were in commoditized businesses, and therefore they were not really that marquee in that sense. Chemicals, financials, building materials and auto ancillaries. And the interesting bit is the average price to earning ratio in FY11 for each of these 68 companies was only about 18 times. So that's the other interesting bit. Now, what came out of this list is 2 or 3 things that you got to monitor. The performance of some of these companies as the period went by was pretty interesting. The sales growth, average statistics, this is the average statistics, the sales growth for all of these companies was about 17% in the period, in the 8-year period. The PAT growth was 19.9%. A large portion of the gains came in through PE re-rating. So not just that there was an earnings growth of 19.9%, which is the average growth, but there was a PE re-rating of about 2.7 times on average, and the market cap growth for these companies on average was nearly about 37%. Just look at the next table, and that will tell you that kind of gives you an insight into what really happened. If you look at the average market cap, these are averages for this list of the 68 companies. The average market cap as of FY11 was 2,462 crores. As of FY19, this average market cap grew to 26,000 crores. However, the return on equity came down for each of these companies as the size went up. Not a whole lot, but from 24.4%, the average return on equity came down to 21.6%. And naturally, because of the price growth and because of the returns that these stocks gave, the PE of each of these companies, average was 13.3 times, went up to 35.3 times. And the ranges were quite stunning too, but more importantly, it is these averages which matter. Went up from 13.3 times to 35.3 times, and that tells you that how it was not just an earnings growth led thing, but a P multiple re-rating as well. The other bit is the dichotomy that while you had positives coming out of this because investors made money, the sad part, I mean, and the CAGR returns were about 37% for the group, meaning about 23 times, but the dividend yield for these companies in average dropped from 1.9% to 0.8%, naturally so because the price went up, and the price to book jumped from 2.9 times to 6.6 times, and that's quite something, right? I mean, even on the financial names, the average price to book went up about 6.6 times. There was a Kotak Bank, IndusInd Bank, I'm guessing Bajaj Finance was there, and therefore the average price to book really jumped up for this list as well. But just the key learning that I think Samit lays out as a result of this and as a result of this study, 2 parts. One, that you need small caps, quality small caps in your portfolio to make those multi-bagger returns, 26% CAGR over an 8-9-year period. But ROE, which can be reinvested, is a big thing. So he's saying two things. One, that compared to a really high ROE with very little room for reinvestment, a reasonable return on equity, which is about 20 to 30% for a company, with a high and a prolonged reinvestment opportunity, creates tremendous wealth. And for most of these companies, ROE remained flat and actually came down slightly, and still these companies generated phenomenal returns due to the growth created from high reinvestment. Most of these companies were able to reinvest the monies that they got in because of the nature of the business into growth, and that resulted in this 26% CAGR. Pretty interesting memo. You can log on to his website and try and read more about this. History may not repeat itself, but it certainly rhymes, and you can benefit out of it.